It's the first Friday of the month, and we don't have a jobs report for the first time in a long time, so gold not reacting to that. But here to talk to us today about the looming debt ceiling is Peter Schiff of Euro Pacific Capital. So, Peter, what are you expecting out of the gold prices, at least when we get into this debate about the debt ceiling?
Well, I think what's good for gold is when they raise the debt ceiling, because it confirms that we're going to have a lot more debt and a lot more money printing. So if they were not to raise the debt ceiling, which would certainly be in the best interest of the country, that type of event might be interpreted as being bearish for gold. But certainly clearing the path for additional debt and more money printing is exactly what the gold market wants.
Sure. So, do you think there's an actual chance that they do not raise the debt ceiling?
Well, I don't know. I mean, what's the snowball's chance in hell? I mean, it's a slim chance. They've raised it every time it's been approached. And many times there's a lot of political theater where they talk about not raising it, but they always do it. And, of course, the real crisis isn't the debt ceiling. It's the debt itself. The ceiling would limit the crisis, but they keep moving it. And, you know, when President Obama says that we have to raise the debt ceiling because America always pays its bills, he's wrong. The reason we have so much debt is because we never pay our bills. And the reason that we have to raise the debt ceiling is because we can't pay the bills, so we want to borrow more money instead. If we leave the debt ceiling alone, then we finally actually have to deal with the bills. And the problem is we've borrowed so much money, it's impossible to pay it back. And that's what the president doesn't want our creditors figuring out.
So, Peter, I'm wondering, we've been talking about the debt, it seems like forever, since the financial crisis, even before that, through the George W. Bush administration. What I'm trying to figure out is for gold prices, at what point does this mounting debt actually affect the trading of gold?
Well, I think it already has. If you've looked at how far gold prices have increased over the last decade or so, a lot of that is a function of the debt and the inflation that has accompanied the creation of all that debt. Certainly over the last couple of years, gold has retreated somewhat, and I think that had to do with the fact that so many speculators jumped on the gold trade after gold had made such a big move. And I think they lost patience over the summer this year, or maybe even rather in the spring, and everybody began to bail out of the trade. And so you had a lot of technical overhang, and you have a lot of negative sentiment now in the gold market, which I think is very misplaced,
right,
but ultimately very healthy for the long-term bull market, which I think is going to resume with a vengeance very soon.
You know, it's interesting that you mentioned that. I mean, a lot of the analysts have been coming out, Goldman Sachs, Bank of America, and they've been cutting their price targets for year end into 2014. I mean, you're obviously disagreeing with them. What do you see that they don't?
I see a lot of things that they don't, but, they're basing this on three things that are not going to happen. They're saying that the U.S. has a viable recovery that's going to continue, that the Fed is going to stop the quantitative easing and begin tightening monetary policy, and that inflation is not a concern. They're wrong on all three. The U.S. economy is not really recovering. It's phony, and we're on the verge of another recession. The Fed is not about to taper or end QE. In fact, they're probably going to increase the amount of QE that they're providing into the system. And inflation is a problem, and it's going to get worse. So they've got it all wrong, so they're mispricing gold.
Right. Well, Peter, you mentioned inflation and that it's coming down the pipe. But so far, we have seen the Fed come out again and again and say inflation doesn't seem to be the trouble. In fact, if anything, there had been at one point a worry of deflation. So I'm trying to where does that come from?
Well, the Fed is lying. And first of all, deflation would not be a worry in the sense of falling prices, consumer prices. That's a good thing.
When you say the Fed's, what do you mean the Fed's lying?
Well, because the Fed has to create the false impression that there's no inflation because they have to validate their cheap money policy. If they acknowledged all the inflation that they've already created, they'd have to raise interest rates, but they can't without destroying the phony recovery that they helped create. So they have to deny the obvious. And it's amazing to me that so many people on Wall Street buy the Fed's propaganda. Because if you actually look at what's happening to prices, they're rising pretty rapidly for just about everything that Americans buy. And of course, Inflation, by definition, is the expansion of the money supply. That's exactly what the Fed is doing with quantitative easing. It is inflation simply by another term.
Well, it does seem that a lot of Wall Street does still focus on a core inflation rate, which is what most analysts continue to look at. Peter, I know you disagree with a lot on Wall Street. Some of your ideas might be a little bit different from others, but we do appreciate having you on and hope to have you back.
Hey, anytime.
All right. For The Street,